Welcome to Lior Times. I'm your global business correspondent, and tonight I'm bringing you a story that international banks, central banks, and governments are quietly trying to keep out of mainstream news. The global economy is sitting on top of a debt bomb that the world's most powerful institution, the International Monetary Fund, has just publicly warned about. The numbers I'm about to share with you in the next 8 minutes will shock you. Some of them will scare you. But every single number is verified, sourced from official IMF reports released in April 2026. Stay with me, because what is happening right now will shape the next decade of global economic history. Let me begin with the single most shocking number on planet Earth tonight. The United States national debt has crossed $39 trillion. Just absorb that, $39 trillion. The IMF officially confirmed this on April 16, 2026 at its spring meetings. In perspective, the entire global economy produces about $110 trillion in GDP every year. The United States alone owes over one-third of one full year of global economic output. And here's the part nobody is telling you. The IMF expects total global government debt to reach 100% of global GDP by the year 2029. That would be the highest level of debt the world has carried since the immediate aftermath of World War II. But that is just the surface number. The real shock is hidden underneath. Look at the major economies. The United States debt to GDP ratio now stands at 125%. Japan, the world's third largest economy, sits at a staggering 230%. Singapore is at 176%. France is at 117%. Combined is at 110% debt to GDP. This is not a developing world problem anymore. This is a rich world problem. The countries that print the world's reserve currencies are now the most indebted nations on the planet. Now let us talk about the truth that nobody on mainstream financial television wants to say out loud. The global financial system has changed. In 2008, when private banks collapsed under the weight of bad mortgages, governments stepped in and bailed them out. The state absorbed the shock. But today, in 2026, the situation is reversed. The governments themselves are the source of the toxic debt. They are the ones who are over-leveraged. They are the ones frantically issuing new bonds to cover exploding deficits. If a major sovereign balance sheet cracks under stress, there is no larger entity left to bail them out. The shock absorbers are gone. Now connect this to the war happening right now. The Iran-Israel war, the disruption of the Strait of Hormuz, and the surge in global energy prices are pushing inflation higher across every major economy. The IMF specifically modeled this scenario. In their severe scenario, oil prices remain 100% above pre-war levels through 2027. Gas prices stay 200% higher. Inflation expectations rise by 90 basis points in emerging markets. Sovereign borrowing costs in emerging markets rise by another 50 basis points. This is not theoretical. This is the IMF's official April 2026 projection, written into their World Economic Outlook Chapter 1. Now let me share the most underreported story of this crisis. Turkey is quietly moving $30 billion of its gold reserves stored in the Bank of England in London. Turkey's central bank is doing a massive bullion for foreign currency swap because the country's economy has been hammered by the war shock. Turkey is the canary in the coal mine for a $106 trillion global financial system. For decades, the structural assumption of international finance was that American sovereign debt and the dollar were the ultimate safe harbor. That assumption is now being quietly questioned by central banks all around the world. Russia, China, India, Saudi Arabia, the UAE. All of them have been adding gold to their reserves at record pace. Gold prices have climbed roughly 53% in 2025 alone. This is not normal investor behavior. This is a structural rejection of the dollar system. Let me tell you about another shocking pattern the IMF identified. War spending around the world has surged. The IMF data shows that during a typical defense spending boom, military outlays rise by about 2.7 percentage points of GDP, sustained over 2.5 years. About two-thirds of this spending is financed through deficits, meaning more debt. Public debt rises by 7 percentage points within just 3 years. In wartime booms specifically, public debt jumps by 14 percentage points, and crucial social spending like healthcare and education drops sharply. This is happening right now in 2026 across many advanced and emerging economies. The world is borrowing to fight wars while letting its citizens fall behind. Now let us talk about how this hits ordinary people, especially in countries like India. When global debt rises, when major economies struggle, when the dollar system wobbles, the spillover effects are predictable. First, capital flows out of emerging markets and into perceived safe havens, like US Treasuries, gold, and the Swiss franc. The Indian rupee weakens, imported goods become more expensive, inflation rises. Second, global trade slows because uncertainty kills business confidence. India's exports of software, generics, textiles, and engineering goods come under pressure. Third, foreign investment into India slows because international investors prefer to sit on cash during turbulence. Fourth, oil importing countries like India bear a disproportionate burden of energy inflation. India imports over 80% of its crude oil. Every dollar increase in Brent crude adds approximately 10,000 crore rupees to India's annual import bill. Now let me share the angle that almost no other channel is willing to discuss openly. The petrodollar system, which is the foundation of American economic supremacy, is showing real cracks for the first time in 50 years. The petrodollar system is the arrangement under which most global oil is priced in US dollars, forcing every country on earth to hold dollar reserves. This created artificial global demand for the dollar. It allowed America to run massive deficits without consequences. It gave the United States what economists call exorbitant privilege. But now, with the Iran war disrupting oil flows, with sanctioned countries trading oil in yuan and rupees, with central banks accumulating gold instead of treasuries, the foundation of that 50-year-old system is quietly being eroded. If even 20% of global oil trade shifts away from dollars in the next 5 years, the consequences for US debt sustainability would be enormous. So what does all of this mean for you, the global investor, the entrepreneur, the policymaker, the ordinary citizen watching this from India or anywhere else in the world? It means you must understand that we are living through one of the most fragile economic moments in modern financial history. The signals are loud, but most of them are being ignored or downplayed. Government debt is exploding, inflation is sticky, wars are reshaping commodity flows, central banks are quietly diversifying away from the dollar. Gold is at record highs, Turkey is moving its reserves, emerging markets are bracing for capital flight. And the IMF, the most cautious institution in the world, is using language like the world has less degrees of freedom and the global economy is being tested again. When the IMF speaks like that, smart investors listen. The bottom line is this: we are not heading into a normal recession. We are heading into a structural reset of the global financial order. The investors who survive and thrive in the next decade will be the ones who diversify across currencies, hold real assets like gold and quality real estate, avoid excessive debt, and stay informed. This is not a moment for panic, but it is also not a moment for ignorance. Information is the most valuable currency in the world right now, and that is exactly what Lior Times will keep delivering to you. That is all for this edition. If this analysis opened your eyes to what is really happening in the global economy, please subscribe to Lior Times and hit the bell icon.